Hare Krishna. Welcome to Tax Guru YouTube channel. This is CRO and R. Pingle, practicing chartered accountant based in Mumbai. Also partner in Motilal and Associates LLP, member firm of Marks Network. And today I'm going to recording this special video on the topic non-corporate entities, financial statements. Yes, so we will let's move into directly on the topic financial statements of non-corporate entities. Let me allow to share my screen. So non-corporate entities, financial statements. Today we are going to discuss under this topic is what we are going to cover is structure, components, and disclosure requirements of financial statements of non-corporate entities. Main content that is key heads and details like balance sheets, statement of P&L and cash flow statement, common errors or non-compliances noted by FRRB, some issues and solutions, checklist for preparing NCE financial statements as a point of view, the article assistants or those who are dealing with the NCEs, for them, this checklist is very important. And then few of the red flags to watch out for. And after end of the session, after ending of the session, we will go to see the formats of balance sheet, statement of P&L, and cash flow. So let's start with it. Financial statements of NCEs. These are the backbone of the financial reporting. Means financial statements are the backbone of the financial reporting, enabling stakeholders to assess the financial health and performance of the entities. The preparation and presentation of financial statements are governed by under the NCEs. ICAI's revised accounting standards for NCEs, categorized into level 1, level 2, and level 3 entities based on size and criteria, that is based on the turnover. The objective is to ensure what is the objective of setting these guidelines or accounting standards for NCs is to ensure uniformity, transparency, and comparability while reducing the compliance burden for smaller entities. Next. So main content, key heads and details. Under that, we are going to cover the applicability and levels of non-corporate entities, components of financial statements for non-corporate entities, that is NCEs, balance sheet presentation we will see, statement of profit and loss, cash flow statement, significant accounting policies and disclosures, special points for NC. So we will see these one by one. So let's start first. Applicability and labels of non-corporate entities. The classification by ICAI revised 2024 guidelines is like level 1, level 2, and level 3. So level 1 is large NCs meeting specified criteria. For example, turnover more than rupees 250 crores. So those entities who have a turnover more than 250 crores will be covered under level 1 entities. Level 2 entities, medium size entities, turnover between 50 crore and 250 crores. That is turnover exceeding 50 crore is turnover exceeding or equal to 50 crore to 250 crore. and level 3 will be small entities turnover less than 50 crore. So when you reach to 50 crore, you will be covered in level 2. And if you are a 49 crore, less than 50 crore, you will be covered under level 3. So level 1 called it as a large entities, level 2 called it as a medium size entities, and level 3 called it as small entities. So what is the impact of it? So different disclosure and measurement requirements apply based on the level. Whenever you are covered under level 1 or level 2, depend on that, you have to comply your disclosures and measurement requirements. So for example, a partnership with 10 crore turnover will fall under which level? Level 3, and can apply simplified accounting standards like AS for SMEs, small medium enterprises. So next is a components of financial statements for non-corporate entities. As per ICAI guidelines, what are the components? Main components are balance sheet, statement of profit and loss, cash flow statement, and cash flow statement only in an indirect method and also applicable to whom? Only level 1 entities. Optional for 2 and 3, means they are not mandatorily follow or not mandatorily prepare cash flow statement and disclose the level 2 and level 3. They can do and on as per optional method, but level 1 entities has to mandatorily follow or prepare the cash flow statement. Okay, and that is also indirect method should be used while preparing the cash flow statement, and notes to account including significant accounting policies. So four major components of the financial statement for NCEs is balance sheet, statement of profit and loss, cash flow statement, indirect method applicable mandatory to level 1 and optional to level 2 and level 3 entities, and notes to accounts including significant accounting policies. Let's see balance sheet presentation. So we will see the proper format where at the end of the session, we will just glance through the major components of the balance sheet presentation. So assets and liabilities grouped under heads like non-current and current assets and capital and liabilities. Those who are following schedule 3 also, they know these are the same but little bit in a different mode. Otherwise, it is like the same like a schedule. So assets and liabilities grouped under the heads like non-current and current assets like property, plant and equipment, investments, receivables, and capital and liabilities, that is capital accounts, loans and provisions. Capital account, why? Because the non-corporate entities covers partnership firms. So therefore, or even those sole proprietor, those who have a capital account. So that is the main component of in a NCEs. So capital and liabilities, which includes capital accounts, loans and provisions, and non-current and current assets, property, plant and equipment, investments, receivables. So no specific format like Schedule 3 for NCEs, but on the same line, if you see the format, it is a same line. It is not any much different you will see. So ICA provides the illustrative formats, and that illustrative format is like same like a schedule 3 if you see. So example, capital account opening balance 50 lakhs plus current year profit 10 lakhs minus drawings 2 lakhs. So your closing balance of the capital account 58 lakhs, and it will be put into the capital and liabilities part. You will show under that. So what are the key points? For partnership firms, owner's funds is equal to what? Capital plus your current account balances of partners. So this is the main how you can present is the question. So it is cleared by this. For partnership firms, owner's funds will be what? Capital account plus current account balances of partner is your owner's funds, and drawings and profits are adjusted in capital account or current account as per partnership deed. So your drawings and profits would be adjusted in capital account or current account as per partnership deed. For proprietorship, capital shows proprietor's investment. Simple. So notes to accounts to disclose significant accounting policies and detailed breakup is what accounting policies you are followed. That should be mentioned under the notes to accounts. Next, statement of profit and loss. So the statement of profit and loss presented in shows what income and expenses for the period, and disclosure of accounting policies for revenue recognition is crucial. It is how you recognize the revenue. That policy, that method should be disclosed as an accounting policy for revenue recognition. And it is a crucial part of this, the financial statement of NCEs. That should be mentioned. So common heads in statement of profit and loss is revenue from operations, other income, employee benefit expenses, depreciation, and finance cost. Because if you see, it is on the same line. The illustrative format is prepared on the same line of a schedule. So the common heads, revenue from operations, other income, employee benefit expenses, depreciation, finance cost, and it is the same like vertical format. Example, revenue from sale of goods recognized when significant risk and rewards are transferred to the buyer as per accounting standard 9. This is an example, and you can mention that as a disclosure of accounting policy in that notes to accounts. So key points under this is for proprietorship and partnerships. Drawings are adjusted in capital. It should not be a part of the expenses. Drawings should be adjusted capital account and not shown in P&L. Tax expenses includes current tax and deferred tax if applicable for level 1 entities. So level 2 and level 3 is out of the question. So tax expense includes current tax and deferred tax. If entity claims exemption, in case of trust, disclosure should be made accordingly. Very important. Means if you have a trust as a NC, so if you are claiming the exemption, the disclosure should be made accordingly. Now moving onwards, cash flow statement. Mandatory for level 1 NCs as per ICAI notification, prepared using purely indirect method, no direct method, indirect method. That is adjust profit for non-cash and working capital changes. We will see the format so that you will be very clear at the end of the session. So be there till the end of the session. Example, net profit rupees 5 lakhs plus depreciation 50 lakhs minus increase in debtors would be 30,000. So your operating cash flow would be rupees 5,20,000. It is a indirect method. And now next disclosures with respect to significant accounting policies and disclosure. So as per AS1 revised, policies on basis of preparation, revenue recognition, depreciation method, valuation of inventory, employee benefits must be disclosed. And more important is all significant accounting policies should be presented in one place. It should not be scattered. It is the one of the observation by FRRB. So your all significant accounting policies should be presented or disclosed in one place, should not be scattered. And other notes, that is contingent liabilities and commitments, related party transactions, if any, should also be part of your accounting policies. So let's see example of policy disclosure. Inventories are valued at lower of cost or net realizable value, cost being determined on FIFO basis. This is one of the example of policy disclosure. Next, special points for NCs. What are the special points for NCs? No index applicability for NCEs. So you are all NCEs are out of applicability of Indian accounting Ind AS, that is applicability of index. Simplified disclosures for SMEs, small and medium enterprises are with the simplified disclosures for them. So example is no requirement for earnings per share, segment reporting or complex fair value measurements. Means SMEs are keep out for this disclosure. What? No requirement for earnings per share, segment reporting, or complex fair value measurements. So, and now we are going to FRRB, what I mentioned in earlier. FRRB, the full form is Financial Reporting Review Board. Observations stress that entities must avoid scattered policies. I earlier told you that your accounting policies should be at one place, should not be at a scattered. This is one of the major observation by FRRB, that is Financial Reporting Review Board, that it must avoid scattered policies and ambiguous notes and must comply with AS in spirit and letter. Now we are going to measure common errors and non-compliances noted by FRRB. These are the most important. We need to study this. So we will be able to avoid these common errors or non-compliances in our NCE's client or anyone. So first we will see one line, what are the actually common, and then we will go through in detail. Okay. So first common error or non-compliances noted by FRRB is non-disclosure of significant accounting policies. Second is incorrect classification of items in balance sheet. We will see one by one. Okay. Don't worry. So just we have to first we glance through what are the common errors noted by FRRB. That is non-disclosure of significant accounting policies, incorrect classification of items in balance sheet, scattered presentation of accounting policies, valuation of inventory only at cost, ignoring NRV, ambiguous or misleading accounting policy wording, improper treatment of MAT credit for firms under tax audit, use of incorrect nomenclature under Ind AS framework, that is for level 1 firms using Ind AS voluntarily. Revenue, that is major error or non-compliance. You will see under that. Revenue recognition policy missing timing aspect. Revenue recognition policy missing timing aspect. And cash flow errors, not using indirect method or missing disclosures. So let's see one by one in detail. First common error is non-disclosure of accounting policies. Under that, what was the error noticed by FRRB? Entity didn't disclose the accounting policies for revenue recognition, inventory valuation, and employee benefits. Means entity didn't disclose only that accounting policy for revenue recognition, inventory valuation, and employee benefits. So what we will see the practical example. A partnership firm engaged in manufacturing discloses in its notes income and expenditure are recorded on accrual basis. They only disclose this one line. What? Income and expenditure are recorded on accrual basis. It doesn't specify when revenue is recognized, that is on dispatch or delivery, method of inventory valuation, FIFO or weighted average, and treatment of gratuity or leave encashment under employee. So impact will be users cannot understand how revenue or inventory is measured. So to know the basic of fundamental thing is that the user of the financial statements, if they want to know how the revenue is recognized, one should disclosed properly. Very important. So correct disclosure would be like revenue from sale of goods is recognized when significant risk and rewards of ownership are transferred to the buyer and inventories are valued at lower of cost or NRV, cost being determined on FIFO basis. Means everything is mentioned here, how revenue is recognized, how inventory is valued, and which method is also followed. So this is the correct disclosure. Now moving to second error or common non-compliance is incorrect classification of items in balance sheet. Error was long-term loans classified under current liabilities. So example, a non-corporate entity has a term loan of rupees 25 lakhs repayable in 5 years, but it's shown under current liabilities instead of non-current liabilities. Because in current liabilities, the period of liability will be from the reporting date will be the 12 months. That only covered under the current liability. But here, 25 lakh of term loan repayable in 5 years disclosed under current liabilities instead of non-current. So impact was mislead the users about the liquidity and solvency. So correct classification would be current liability only the amount due within 12 months from the reporting date, and non-current liability balance repayable after 12 months. Now moving to next common error, scattered presentations of accounting policies. So error observed was some policies are shown under significant accounting policies and others scattered under respective heads. That should not be happen. It should be at one place only. So example, policy on fixed assets given in note 1, policy on revenue recognition given in note 20, that is related to sales, and policy on employee benefits given in note 25. So they are given on respective notes, but that should not be a right disclosure. Right disclosure should be, so your accounting policy should be disclosed at one place. So the impact of disclosing at a different schedules or notes, users cannot easily locate all policies in one place. If that should happen, what to do? The correct approach would be all policies should be grouped under a single heading, significant accounting policies at the beginning of notes to accounts. Next common is valuation of inventory only at a cost, ignoring NRV. So error observed was inventory value only at cost without considering lower of cost and net realizable value as per AS2. So practical example, closing stock of raw material rupee cost 10 lakh and NRV 8 lakh. Finished goods cost 15 lakhs and NRV 14 lakhs. Entity records raw material at 10 lakhs of cost, ignoring the NRV 8 lakh because whichever is less, so it should be valued at 8 lakhs, not 10 lakhs. And in case of finished goods cost 15 lakh and NRV 14 lakhs, finished goods it valued at 15 lakhs, ignoring the NRV 14 lakhs. So impact, what is the impact of this presentation? It overstatement of assets and profits. So correct valuation, raw material at 8 lakh, that is the lower of cost, or NRV, that is 8 lakh is a lower than cost, and finished good also at 14 lakhs compared to 15 lakhs. That was the correct presentation. Next, ambiguous or misleading accounting policy wording. So error observed was the FRRB's policies mentioned as per A's issued by ICAI without specifying the actual method. So policies stated as borrowing costs are capitalized as per A16 issued by ICAI. It doesn't mention the criteria for capitalization, rate used, or treatment of general borrowings. These are the missing in the above disclosure. And the impact was reader cannot understand the actual method applied. So correct disclosure would be borrowing cost directly attributable to acquisition or construction of qualifying assets are capitalized till the asset is ready for intended use. Other borrowing costs are expensed. Means everything is mentioned in this. So this is the correct disclosure. Next common error, improper treatment of MAT credit for firms under tax audit. So error observed was MAT credit entitlement recognized as an asset without a disclosure of basis or convincing evidence. So let's say example, entity recognized MAT credit of rupees 5 lakh under loans and advances without stating what that it will be utilized within specified period and basis for recognize it. Impact would be inflated assets, lack of clarity to users. So correct disclosure would be, in that case, MAT credit recognized based on convincing evidence that it will be realized in future years within the specified period. This should be a correct disclosure for that. Next, use of incorrect nomenclature under Ind AS framework for level 1 firms using Ind AS warrant level. So error observed was term used as tangible assets instead of property, plant and equipment as per Ind AS 60. So if you are following Ind AS, then what word you need to use is property, plant and equipment and non-tangible assets when you are applying Ind AS. So the error was that they are used term tangible assets instead of property, plant and equipment. So practical example, in balance sheet, tangible assets of rupees 1.2 crore. Instead, it should show as a property, plant and equipment. So impact will be non-compliance with Index Schedule 3 format. Means if you are using the words tangible assets and following index, then it is an incorrect disclosure. So correct practice will be used nomenclature prescribed under Index and ICAI guidance. So whatever this is the importance of nomenclature too. You need to be use correct nomenclature. You should not follow chalta hai attitude. You must follow a proper structure. Then you need to follow proper nomenclature. Very much important. Next, revenue recognition policy missing timing aspect. Error observed was policy states turnover includes sales and service tax without specifying within risk and rewards transfer. Example, entity sells goods but doesn't state whether revenue is recognized on dispatch or delivery or after installation. So impact was user cannot assess compliances with AS9 revenue recognition. So correct disclosure would be revenue is recognized on transfer of significant risk and rewards of ownership, generally on delivery of goods to customers. This is the proper disclosure. This disclosure you will see as a one line, but it is very much important. What is to be stated in your one line? It is a weightage, so it is very important. The next error related to cash flow errors, not using indirect method or missing disclosures. So error observed was large level 1, that is level 1 NCE fails to provide because the cash flow applicable to level 1. But even though if you are optional and you are applied properly and correct disclosure should be made. So NC level 1 NC fails to provide reconciliation of liabilities arising from financing activities as required by Ind AS 7 if applicable voluntarily. So practical example, loan opening rupees 50 lakhs, closing 60 lakhs, but no reconciliation given for additional borrowing and repayment. Only opening and closing. So in between, what is how its closing balance 60 lakh arrived, no reconciliation is given. So impact was lack of transparency on financing cash flows. So correct disclosure would be provide a separate note showing movement in borrowings and interest. Okay, so we have discussed all the common errors or non-compliances noted by FRRB. Now, next, we will see some issues and solutions to it. Okay, and then we will move to checklist. So, what are the issues? The issues are understanding applicability of accounting standards, classifications of items in balance sheet, disclosure of significant accounting policies, valuation of inventory. Means the issues are related to this. So I'm just glancing through the issues and then we will see the actual issue and the solution too. So treatment of owner's capital, drawing then current account, cash flow statement preparation level 1 NCs, taxation and MAT credit, handling related party transactions, documentation and working papers, lack of awareness of latest ICAI guidelines. Very much important. As a practicing chartered accountant, we are servicing, we are providing value added services or value services, we need to be updated regularly, and that is important. We must first, and then our article assistant also, or our employees also should be updated to the latest guidelines, whatever it may be, government guidelines, if it is ICAI guidelines or it is NCA guidelines, we need to be regularly updated. So we will see first under that some issue is understanding applicability of accounting standards. So what was the issue? Issue was determining which accounting standards apply to level 1, level 2 or level 3 NCs. Okay. Means confusion whether AS15 fully applies to level 3 partnership firm. Means there are many confusions while applying any provisions or any new formats. We will come across many confusions. So the risks of over disclosure or non-compliance if we have continued with that confusion. So what is the solution to that issue is referred to ICAI revised AS framework for NCs as we are discussing NCs and classification criteria. Or if in case there are if there is any other guidelines, we must first go through that guidelines and then we will, so that once we will went through the guidelines, the confusions will be lesser and lesser. Next, classification of items in balance sheet. So the issue was proper grouping of assets and liabilities without Schedule 3 format. So example, misclassifying long-term loans as a current liabilities, we have just seen that, or failing to separate drawings from the business expenses. Means drawings are included in the business expenses. That should not be happened. So impact misleading liquidity and solvency position. So solution again is a use ICAI illustrative formats for NCEs and ensure owners' capital adjustments are correct. Means that illustrative format will help as a checklist or as a guidelines to us to follow a proper structure to any preparation of the financial statements, or we can check whether that is followed by that particular NCE management accounting staff. Next, disclosure of significant accounting policy. Issue was what often ignored or scattered across the notes. Policy on depreciation given in one note, policy on revenue recognition missing completely. So impact what is non-compliance with AS1. And the solution would be prepare a consolidated significant accounting policy, only one major head, significant accounting policies, and that should be note at the beginning of notes to accounts and should be at one place that under that heading only. Valuation of inventory is next issue. Many assistants take physical stock value as a final without applying lower of cost or NRV principle. This is the major issue. So, like example, raw material cost 10 lakhs, NRV 8 lakhs, but assistant uses 10 lakh. So, impact poor statement of profit, assets and profit, and the solution is for that is apply is to consistently and document the basis of valuation. Means you have to check or ask your assistant, or you need to first see whether the AS2 followed, whether we have seen to compare the cost and NRV. If NRV is less, then NRV will be the value should be the part of the financial statement. Or if cost is less than, but need to be see that this comparison is made. Next, treatment of owner's capital drawing and current account. Issue was mixing up the drawings and business expenses. Example, proprietor withdraws rupees 50,000 for personal use. Assistant book it under office expenses instead of adjusting with the capital account. So impact definitely incorrect P&L and capital balance. So solution for that is clearly separate the personal drawings from the business expenses. Because after one withdrawal, how much proprietor keep for a personal use and how much he brought into the business is the division should be properly made from the inception. If you need to guide the accountant of the proprietor, or you need to guide the proprietor to how to keep the accounts. Cash flow statement preparation. This cash flow applies to level 1 NCEs. Issue was a difficulty in applying the indirect method and reconciling the non-cash adjustments. Example, forgetting to add back the depreciation while calculating operating cash flows. So impact incorrect cash flow of reporting. So solution, start with net profit before tax and then adjust for non-cash items and working capital changes as per AS3. Means you have to start with net profit before tax and then adjust for non-cash items like depreciation and working capital changes as per AS3. Next issue, taxation and MAT credit. Issue was incorrect calculation and disclosure of deferred tax or MAT credit. Example, recognize MAT credit without checking the realizability or missing disclosure basis 2. The impact mislead assets and compliance risks. The solution for this is recognize the MAT credit only when there is a convincing evidence of utilization. Handling related party disclosure. This is also a major part of this. Handling related party transactions. The issue is not identifying the transactions with relatives of partners or owners. Means first we have to take a list or ask assistant to take the list in case of partnership firms to who are the relatives, whose relatives of the partners and anybody names reflected in financial statements, you have to identify it based on that. So the first thing is to take a list of the persons who are relatives of the partners. You need to see that. So payment to partners brother for consultancy ignored in related party disclosures, even if it is a proper business expenses, but if it is given to the brother, this need to be disclosed under related party disclosure. So impact, if it is not, if you are not did, then violation of AS 18, that is accounting standard 18, that is related party disclosure, if applicable. So solution would be collect complete related party details, as I mentioned, and ensure proper disclosure. Next issue is related with documentation and working papers. These last two issues are related to our own working as a CA, as our assistant, what our assistants are doing. We need to have a control or keep track on that. So documentation and working papers. The issue is what lack of proper documentation for valuation, depreciation, and accounting estimates. Is even though we need our audit papers, our audit working papers is like same thing with the assessee, our client. The accountant of the client or assessee has to keep all the documents of valuation, depreciation, accounting estimates and a proper in their documentation part. No supporting for useful life of assets used for depreciation. Means you have to see that, verify that the auditor queries and FRRB scrutiny is what would be the impact. The solution, maintain a file of assumptions, calculations, and client confirmations. So you need to instruct your client's accountant and client to how you need to follow the basics of this. Then after you will be able to properly verify the things of the your client. And then last, lack of awareness of latest ICAI guidelines. Assistants often refer to old AS applicability and format. So that what I have mentioned earlier in today's our session is that we need to be updated regularly, and also our assistant and employees also need to be updated, and that is the major thing in the coming future. Our assistant, our employees should be trained properly. They should be given a proper training. The weekly sessions or fortnightly sessions with them should be taken place in your office or wherever it is possible. You need to guide them. Okay, so this need to be done for that. So the non-compliance with ICAI revised 2024 means this is the impact. If you are not updated, then definitely there will be errors or mistakes or omissions, or that is the basic also. So solution is regularly check ICAI guidelines and FRRB reports as we are discussing NCEs, but we must regularly update our sales. Is our your aim should be is that you should organize in that key weekly or fortnightly a training session should be given to your assistant or your employees, and then also you must on your own also attend our institutes, our BCAs or whatever you are associated any study circle, you need to attain those lectures to keep yourself updated. So very much important. And now we are going to the next part, checklist for preparing NCE financial statements. Okay. What is again we will glance through what checklist we are going to see. So while preparing NCC will be benefited, and then we will also one by one in detail we will see. So first checklist is related to preliminary checks, compliance with accounting standards, checklist with balance sheet preparation, checklist related to your P&L account, checklist related to your inventory valuation, checklist related to depreciation and fixed assets, checklist related to cash flow statement, checklist related to taxation and MAT credit, checklist related to notes to accounts and disclosure, checklist related to final review before submission. So one by one now we will see the checklist. If you are listening it carefully and note it down. Okay, please note down because I'm going to speak what checklist you have to go. So if you have a always while you are listening any such type of sessions, you need to have a pen and notepad. Or if you have a techno savvy, you can note it down on your phone too. So let's start with the preliminary checks. Under that, verify first entity type. What is it? Proprietary, partnership, firm, trust. What is the type of entity? Then determine the level of, once you determine where entity type, then you have to determine the level of classification, level 1, level 2, level 3. That is based on the turnover as per ICAI revised paper 2024. Then collect. Third one is collect previous year financial statements for consistency check. And then obtain trial balance, ledgers, inventory details, bank statements, and tax computation. So these are the preliminary checks. Next, compliance with accounting standards. What is the checklist? Apply is applicable for NC level is level 1. All accounting standards are applicable. Okay, all relevant A's are level 1 should follow all accounting standards 1 to 29. Level 2, reduce disclosures for some AS and AS 3, 17, 20, 21, 23, 25, and 27 not applicable to level 2 entities. And for other is limited or reduced disclosures for other accounting standards. And in case of level 3, simplified AS and AS 3, 17, 18, 20, 21, 23, 24, 25 and 27 not applicable. So confirm basis of accounting, accrual basis and going concerns, and check consistency of accounting policies with previous year unless justified. Next, checklist related to balance sheet present preparation. Classify liabilities correctly. Very important. There's long-term loans under non-current liabilities. Current portion of term loan under current liabilities, that is covered within a 12 months of from the reporting date, then you have to cover that part under the current liabilities. Like owner's capital. Adjust for drawings, profit share, interest on capital, and bonus as per partnership deed. Ensure assets grouped properly. PPE, that is property, plant, equipment, separate from investments. Means your business PP and your investment should be properly classified as separately. Current assets separate from non-current assets. Very much important. This is the checklist for balance sheet. Now we are moving onwards. Checklist for profit and loss accounts. Exclude drawings and personal expenses and adjust in capital account. Major thing. And the check revenue recognition policy as per AS 9. revenue recognized on transfer of risks and rewards, not on cash receipt. Verify expense classification, employee benefits under employee benefit expenses, and finance charges under finance cost. That is separate heading is given for that. Checklist for inventory valuation as per as to ensure inventories are valued at lower of cost or NRV. Major thing. Document method of cost determination, FIFO or weighted average, and review slow moving or obsolete stock for NRV adjustment. Next, depreciation and fixed asset. Checklist for it. Complete depreciation as per useful life and policy disclosed. Check for addition or deletion register with supporting invoices. This is required to be maybe most of the times we neglect or ignore that. We need to verify with the supporting invoices that additions or deletion during the year. Review for impairment indicators if applicable. Now moving onwards, cash flow statement. What are level 1 NC for a level 1 NC's checklist? Prepare as per AS3 indirect method. Start with net profit before tax, add non-cash items like depreciation, provisions, and then adjust working capital changes. That is verifying investing and financing activities separately. Next, taxation and MAT credit. Checklist for it. Check tax provision calculations with tax computation sheet. Recognize deferred tax only for level 1 entities as per AS 22. Deferred tax not applicable to level 2 and level 3. Record MAT credit only when convincing evidence of utilization exists. MAT credit only record only when convincing evidence of utilization exists. Notes to accounts and disclosure. What is the checklist for it? Prepare significant accounting policies in one place, and under that you need to write about basis of preparation, revenue recognition, inventory valuation, depreciation method, employee benefits, contingent liabilities, related party transactions as per AS 18 if applicable, and events after reporting date like as per AS 4. So this is under the significant accounting policies. And final review before submission. So what is the checklist before submission? Cross verify opening and closing balances with what previous year. Ensure totals match between balance sheet and trial balance. We need to see that also. Even if these are the technically all softwares are now fine. This one effect is given directly to the end of the balance sheet thing. But you just at least you have to test check, take a printout of trial balance and take a printout of balance sheet and just take out some of the items are properly presented or come into the balance sheet. Review ratios for reasonableness. That is like GP ratio, MP ratio. Means you have compared with previous years. Means there whether there is a major change in NP ratio or GP ratio. And then if it is, then you have to analyze or go deep into it. Compare with last year for unusual variances. That just I have mentioned it. Means you have to see that previous year figures, closing balances, and current year closing balances, whether there is a any change, major variances. And if it is there, you have to go into depth and analyze that, discuss with the client whether it is reasonable. Check ICAI recent updates and announcements before finalization. Very much important. Actually, you need to read those guidelines before starting any verification, any audit. And now these are the checklist discussion. And now we will glance through what are the red flags to watch out. So the red flags to watch out are scattered or missing accounting policies. Then you need to be into organized at one place. Misclassification of long liabilities like non-current to current or current to non-current. Inventory not tested for NRV. Missing disclosure of contingent liabilities. Drawing shown as business expenses. We all already seen this in our today's session. Okay, no reconciliation in cash flow statement and incorrect tax treatment for NCE. So these are the few red flags to watch out. And now we are moving to see this is the proper disclosure or proper presentation of the financial statement. This is a balance sheet. Now we are watching a balance sheet presentation in a vertical format. We will just glance through heading, major heading, equity and liabilities, then owner funds, under owner funds, capital and reserve surplus, under non-current liabilities, long-term borrowings, provisions, under current liabilities, short-term borrowings, trade payables, other current liabilities, short-term provisions. If you want, you can take a screenshot of it, or it is available on ICAI guidelines. Of course, in that under guidelines, the link is available. Then under assets, non-current assets, property, plant and equipment, intangible assets, long-term investments, other non-current assets, and under current assets, inventories, trade receivables, cash and cash equivalents, short-term loans and advances, and other current assets. So, and this is the comparable current year, previous year, and for be in between that notes is there. Note numbering is there. How a statement of profit and loss will be presented? It is like this: revenue from operations, other income, total revenue, that is 1 plus 2, and then expenses, under expenses, cost of materials consumed, purchase of stock in trade, changes in inventory of finished goods and WIP, employee benefit cost, finance cost, depreciation and amortization, other expenses, total expenses, profit before tax, tax expense, and profit after tax. This is a vertical format, and if you see, it is based on a prepared, based on the schedule 3 So, in the those who are covered under level 1 entities, they need to prepare cash flow as per indirect method, and the format is like this: net profit before tax, adjustment for non-cash items, depreciation, finance cost, interest income. That gives you the operating profit before working capital changes. Changes in working capital, trade receivables, inventories, trade payables will give you the cash generated from the operation. And the taxes paid, net cash from operating activities. After that, second, cash flow from investing activities. Under that, purchase of PPE, property, plant and equipment, sale of assets, interest received, net cash used in investing activities. And then we will move in third part, cash flow from financing activities, proceeds from borrowings, repayment of borrowings, interest paid, net cash from financing activities, net increase or decrease in cash, cash and cash equivalents at the beginning. So this is what the presentation would be. And before moving, that is the I'm ending the session. If you want to take my contact numbers, take it, my email ID, my contact numbers. If you have any queries, observations, suggestion, any remarks, you can connect with me on my number. The same number is for WhatsApp too, and email ID. You can also email me your observation query, whatever you want to share with me. So that is for the today. While concluding this, we will I'm concluding that the financial statements of NCEs should be prepared with utmost care, ensuring compliance with the ICAI's guidelines, that is prescribed guidelines, and relevant guidance notes too. So proper disclosure, even in a simplified framework, is helping to maintain the stakeholder confidence and avoid regulatory scrutiny. So the importance of financial statement is very much important to the user of this financial statement, and we need to be therefore very much in that while preparing it. The user should be understand from that financial statements disclosure what is this company's what is this NC's providing. When simplified disclosures will help the stakeholders to take a proper decision. To summarize, non-corporate entities enjoy simplified reporting requirements. They will carry on obligation for transparency and compliance. adherence to ICAI guidelines not only fulfill statutory obligations but also enhance the credibility and the trust. So that's it for today's. This is the special session I have prepared for NCEs. So take a help of it. Be in touch. If you are not yet subscribed Tax Guru YouTube channel, then do subscribe it. If you like this video, please click on like and do share in your network and be in touch. I already am taking the video series on GST relearn and what law says under that. The GST relearn we are discussing every topics weekly, means per month, 4 topics mostly. We are now in a second model. Just go it, learn it from that, and then what law says under that. We discuss case laws reported to ITT and High Court under income tax, and cases reported to High Court under GST too. So both direct and indirect taxes covered under what law says. That is also weekly, fortnightly, DT and IDT like that. So be in touch with the Tax Guru YouTube channel. Be in touch with me too. So happy learning. Hare Krishna.